Hi, this is Keith Shabbat, your friend in the mortgage business again, and today we're talking about financing your dream home. When you're financing your dream home, this goes hand in hand with your pre-approval that the mortgage company is going to be giving you. And there's 5 qualifying credit factors that the lenders consider when they're financing your home. Number one is going to be your credit history. And there's 2 elements that they look at when you're doing your credit history: your ability to repay your debts and your willingness to repay your debts on time. This is the only element that they had to judge you based on your point system that we covered in My Credit Score. When they grade you, they're going to see how you're able to afford the home. Is it fit into your lifestyle? Is there anything called a payment shock? Is there too much that you're paying too much for? When you're looking at your income, income is based on your gross income. But in today's world, none of us take home our gross income. We live off our net. So what's important to look at is when you before you purchase a home is to look at doing a budget, because when we look at your gross income, we take into consideration your new house payment and the house payment that you're paying right now, whether it's rent. And we want to make sure that when you're looking at purchasing a home that it does not go over 33% of your gross income. Now, the next one that we're going to be looking at your debts. Now, the debts that we look at are going to be your debts on your credit score, but also the debts that you incur on your lifestyle, your day-to-day debts, cost of living debts like your cell phone, your cable, your phone, your electric, all of those things, food, eating out, church, cost of living. What we don't want to see after you've got done doing your budget is we don't want to see your debts exceed more than 50%. The other thing we're going to be looking at is your employment. In your employment, here is very important to understand. We're looking at a good 2-year history of employment, and we typically like to see our clients in the same line of work. We don't want to be seeing you jumping around doing one thing and going to another thing because it's going to show that you've got an inconsistency in your employment. If you're self-employed, what's going to be important to make sure is when you're doing your tax returns that you're showing a profit at the end of the year. With most self-employed individuals, they're looking at writing off as much as they can. But in today's world, if you write off everything you can and you don't pay any taxes, that means you really don't make any income. The other thing we look at is cash to close. Because the truth is, you've got 2 elements. You're going to have your down payment and closing costs. What we want to make sure is you have the ability of being able to put down your down payment, and then we also want to make sure that you have the ability of financing your closing costs. Now, we don't want to wipe you out. We also want to make sure that you have a little bit of a cushion sitting aside to be able, once you've closed on the home, that you have at least 2 months of reserves. For instance, 2 months of your mortgage payment just sitting in the bank. This is Keith Shabbat, your friend in the mortgage business. I want to thank you for listening. How to Finance Your Dream Home.